Alright, hey traders, just wanted to make a video today on reward to risk, because I think this is a very important concept for investors and traders to understand, um, and almost all of you will understand the concept of reward to risk obviously. However, many people do not put it to use or don't use it in a realistic fashion. So what I want to do in this video is go over a realistic way of looking at the stock market, or any market for that matter, and we have to formulate a way, or at least a statistical reason why a certain reward to risk works better in the long run. So let's assume that we think the stock market's going to go higher, and we buy the S&P, whatever it is at. So what can we change? What do we have power over? Obviously we don't have power over where the market's going to go. It's either going to go up or it's going to go down. We have no power over where it's going to go. The two things we do have power over, however, are how much size you put on, which really is meaningless because, it really depends on what type of trade, how confident you're in it, you are in that trade. So, your size, that variable uh, isn't the most important one. However, obviously it is something you have to take into account. The second variable we can change is how much we're risking to how much we stand to make. So those are really the only two variables we can change whenever we enter a position, because we don't enter the S&P and as speculators, at least we're looking at this from a speculative standpoint, not from a investing standpoint. We don't buy the S&P here and our stop loss is basically S&P at zero. We're not looking at this from an investing standpoint. We have to have some sort of point where we're going to get out no matter what, and whether that be because of a financial loss in the position, hitting your risk limit, or the market just invalidates your trade idea. So once again, we're looking at the market from a realistic standpoint, from an academic standpoint. We're saying that the S&P, or any market for that matter, has a 50-50 chance in the next minute of being up or down. Same thing for the next month, it has a 50-50 chance of going up or going down. The market can only do two things: it can go up or down. So the only real variable, the only thing we can do that will affect our performance when we look at the market from that standpoint is your reward to risk. If you consistently stand to make more than you stand to lose, over time you should make money. Obviously you want to be entering positions in favorable circumstances, ones that have statistically been proven that are, say, bullish or bearish for the stock market. For example, a good example would be to say whenever the stock market drops 5 days in a row, statistically that's a buying opportunity. That's a fact. Statistically it's always been a buying opportunity. So, you can build reward to risk trades off of that. So, you have an idea in place, you have a reason, whether it be an economic picture, a technical indicator telling you to buy or sell. You have that idea in your head, but once again, we have to look at the market as, no matter what our idea is, no matter how confident we are, there's still a 50-50 chance that the market will go up or higher, up or down. So once again, the only thing we can change is your reward to risk. So it only makes sense, over the long run, you should stand to make money if you always risk less than you can make. So once again, a lot of people understand this concept, but it sometimes is difficult to put into use. So you have to be completely confident in yourself that your strategy works. Because if you take on a strategy where you have lower risk, with a higher reward, so say you always risk 1 to make 4 potentially, you typically will have less of a 50% win rate. That's just because market volatility naturally it's easier for the market to fall 1 than it is to rise 4. So naturally the market will take out uh, your stops more easily than your profit targets, so therefore your win rate will be lower than it would if you had a 1-to-1 reward to risk. But the thing that you have on your side is confidence in your strategy. That you know that if you do this over and over again, you should make money as long as you're entering trades in appropriate times. Obviously, we're looking at this from a realistic standpoint where you're not making basically stupid trade ideas, or you're entering the market in unfavorable areas. You want to be entering the market in favorable areas where it's moved before, for example, where in the past this has happened. Basically, you want to be entering trades where you can say this has happened before or something similar has happened before, so I would assume that this happens again. That's a favorable opportunity, and whether that be technical, or whether that be based off of an economic model, that's completely up to you. So basically what I wanted to outline in this video, guys, is just no matter what your trading idea is, economic, fundamental, technical, try and always model your trades around a favorable reward to risk scenario. Because if you do that and you're able to weather potentially more smaller losing trades, you can be confident in yourself that over the long run you should stand to make money. Statistically, it's much easier to make money if you're risking 1 to make 4 than you're risking 1 to make 1, for example, unless you have some sort of information which we're going to assume you don't. So once again, it's just what I want to highlight in this video. I think it's a concept, once again, that a lot of traders understand, but they don't put to use. Another thing that I want to bring up is win rates. For example, you may have a 90% win rate, you may have a strategy that over time has won 90% of the time, but that is just also, that can potentially just be a statistical outlier. Over time, all strategies in some way tend to break down due to different market environments. So the best way to be safe is to just play the market smart and to always risk less than you stand to make. You'll definitely over the long run keep your account from blowing up if you do that. A lot of traders or beginners get into the market and they like the feeling of winning, so they make small gains here and there, but they're risking insane amounts, and then once that insane amount gets hit, once their stop loss gets blown out, their psychology is basically messed up and they can't return to their previous performance. So it's also not just confidence, it's also not damaging your psyche. You don't want to be in a position where you lose a majority of your account or a huge drawdown, and it basically screws up how you think and how you make decisions. So those are a few reasons why I think a favorable reward to risk is definitely the best trade management scenario, and that's why it's a tactic that a lot of the greatest fund managers, for example, use. Yeah, just wanted to outline this video. Hope you guys learned from this video, and have a great day, everyone.